Have you ever heard the phrase and quote, paralysis by analysis and quote? It is a real thing in investing. You sit down to build a portfolio, and suddenly you are staring at hundreds of options. Growth funds, value funds, international funds, bond funds, sector funds. You start wondering if you have the right mix. You second-guess yourself. And sometimes you end up doing nothing at all. Today, I am going to show you a better way. I am going to walk you through two different types of Fidelity funds that are designed for one purpose and one purpose only. To let you set it, forget it, and get on with your life. These are what Fidelity calls single fund strategies, and they might be the smartest, simplest way to invest for your future that you have never heard about. The financial world loves to make things complicated, but the truth is, building a diversified portfolio does not have to mean owning 10 different funds that you have to babysit all the time. Some people do not have the time to monitor and adjust their investments constantly. Some do not feel they have the expertise, and some simply do not want to worry about it, if any of those descriptions sound familiar. Hang around, because a single fund strategy may make perfect sense for you. Fidelity offers two common types of single fund strategies: target date funds and target allocation funds. They both let you own a diversified portfolio through just one investment, but they work in very different ways. Let me explain both, and then I will help you decide which one is right for you. Option number 1. Fidelity Freedom Index Funds. These are target date funds. The concept is beautifully simple. You pick the year you plan to retire, and Fidelity builds a complete portfolio for you that automatically gets more conservative as you get older. The Freedom Index 2060 Fund, ticker FDKLX, is designed for someone who expects to retire around the year 2060. Inside the hood, this fund holds a mix of U.S. stocks, international stocks, and bonds. Right now, with the target date decades away, the fund is invested aggressively. That means mostly stocks, because you have time to ride out the ups and downs. As the target date approaches, the fund gradually shifts toward more bonds and short-term investments. This gradual shift is called a glide path, and Fidelity has been refining its approach since 1996. Let me give you a concrete example. If you look at the Fidelity Freedom Index 2060 Fund, the performance numbers as of late 2025 are quite compelling. Over the past year, the fund returned roughly 20.8%. Over 3 years, about 16.8% annualized. Over 5 years, about 10.2% annualized. And over 10 years, about 10.6% annualized. That is consistent, solid, long-term compounding. And here is the part I love. The expense ratio is just 0.12%. That is $12 per year for every $10,000 you have invested. For a professionally managed, globally diversified portfolio that automatically rebalances and adjusts itself as you age, that is an unbelievable deal. Now, what does the glide path actually look like when you are 20 or 30 years away from retirement? The fund holds roughly 90% stocks and 10% bonds. It is designed for growth. As you get within 10 to 15 years of retirement, the fund starts shifting more heavily into bonds. And eventually, about 10 to 19 years after your target date, the fund reaches its most conservative allocation. At that point, it holds approximately 24% in equity funds, 46% in bond funds, and 30% in short-term funds. That means you never have to make a single decision about asset allocation for your entire life. The fund does it for you. Like I said, it is a set-it-and-forget-it investing portfolio. Option number 2, Fidelity Asset Manager Funds. Now, target date funds are not the only game in town. Fidelity also offers a series of funds called the Fidelity Asset Manager Funds. These are target allocation funds, which means their asset allocation stays constant over time. They do not shift as you age. You pick the level of risk you are comfortable with, and the fund maintains that mix forever. The Fidelity Asset Manager 85% Fund, ticker FAMRX, maintains a neutral mix of approximately 85% in stocks and 15% in bonds and short-term instruments. The fund seeks to maximize total return over the long term by allocating its assets among stocks, bonds, and short-term investments. The manager continuously rebalances the portfolio to maintain that target allocation. This fund holds a diversified mix of U.S. and international stocks, along with bonds and other income-producing assets. Its top holdings include companies like Nvidia, Apple, and Microsoft. The fund has delivered solid performance as well. Over the past year, it returned roughly 21.2%. Over 3 years, about 14.5% annualized. Over 5 years, about 8% annualized. And over 10 years, about 10.7% annualized. The expense ratio is higher than the index-based target date funds. FAMRX has an expense ratio of about 0.59%. But remember, this is an actively managed fund that is constantly adjusting its holdings to maintain the 85-15 mix, and Fidelity has a very strong reputation for managing these asset allocation funds effectively. Fidelity also offers other versions of this same concept. The Fidelity Asset Manager 70% Fund, ticker FASMX, maintains a 70% stock and 30% bond allocation. The Fidelity Asset Manager 50% Fund and the Fidelity Asset Manager 20% Fund offer progressively more conservative allocations, so you have a full menu to choose from based on your personal risk tolerance. So which one is right for you? Let me break it down simply. Choose the Fidelity Freedom Index Target Date Fund if you want a completely hands-off solution that automatically becomes more conservative as you age. This is perfect for someone who wants to pick a retirement year and then never think about asset allocation again. You do not need to know your exact risk tolerance. You do not need to rebalance. You just pick the year and invest. This is especially well suited for retirement accounts like IRAs and 401ks where you are saving for a specific date. The target date fund is also the better choice if you are a nervous investor. Because the fund gradually reduces your risk over time, you never have to worry about being too aggressive right before retirement. The fund handles that for you. Now, choose the Fidelity Asset Manager Fund if you already have a good handle on your risk tolerance, and you want a fixed allocation that never changes. Maybe you are someone who wants to stay aggressive even in retirement. Or maybe you plan to use this fund alongside other investments, like a separate bond ladder or cash reserve. The Asset Manager Fund gives you a stable, predictable risk profile that does not shift over time. The Asset Manager Fund is also a great choice for taxable accounts because its allocation stays constant. You have fewer unexpected capital gains distributions than you might get with a target date fund that is constantly shifting its glide path. Let me give you a simple rule of thumb to help you decide. If you are saving for retirement and you want the simplest possible solution, go with the target date fund that matches your expected retirement year. Type in FDKLX for 2060, FIPFX for 2050, or FIOFX for 2045. Pick the one that is closest to when you want to retire. That is it. If you are a more experienced investor and you know you want to maintain a fixed 85% stock allocation regardless of your age, then consider the Asset Manager 85% Fund, FAMRX, or If you want something a bit more balanced, look at the Asset Manager 70% Fund, FASMX. Now let me give you a few common mistakes to avoid with these funds. Mistake number 1 is stacking target date funds. Do not buy the 2040 fund and the 2050 fund, and the 2060 fund thinking you are getting extra diversification. You are just creating a muddy mess. Pick one target date fund that matches your expected retirement year and commit to it. Mistake number 2 is panic selling during a downturn. A true set and forget portfolio means you keep buying through crashes. These funds are designed to be held for the long term. When the market drops, your automatic investments buy more shares at lower prices. That is how wealth is built. Mistake number 3 is ignoring where you hold these funds, both target date funds and asset allocation funds work best inside tax-advantaged accounts like IRAs and Roth IRAs. Because these funds rebalance regularly, they can create capital gains distributions. In a retirement account, you do not pay taxes on those events. In a regular taxable brokerage account, you might owe taxes each year. Not a deal breaker, but something to be aware of. Thank you for watching. If this video helped you think about your investments differently, hit the like button and subscribe. See you in the next one.